Okay, welcome to Chapter 2 of Corporate and Partnership Taxation. For the purposes of this chapter, I'm going to use individuals to compare and contrast the differences between corporations and other types of business entities, the tax effects, I should say, on corporations and other forms of business entities. And the reason why is because partnerships, some S corporations, and sole proprietorships are all pass-through entities. So they take whatever they receive from the business entity and pay taxes. The business entities themselves do not pay taxes. So basically, if you're a partnership, for example, or an S corporation that has elected to be treated as a partnership, or if you're a sole proprietorship, any net income you've received as a result of business operations isn't taxed by the business entity. It's received by the owner, you, and is taxed there at the individual level. Okay. Some of the things that are different between corporations, well, tax law handles certain aspects of corporations and individuals in a similar manner, and then other aspects in a dissimilar manner. For example, tax rates. Individuals pay, and this is progressively, I might add, 10, 15, 25, 33, 28, 33, 35, and 39.6% tax rates. Corporations, on the other hand, pay 15, 25, 34, 35, 39, 36. I think there might even be a 38 in there, and it's all jumbled up. It's not progressive, okay? But as a general rule, corporations have a higher tax rate for any particular taxable income up to $414,000. What am I saying? Okay. As a general rule, for anything under $414,000, for any taxable income less than $414,000, chances are the corporations are going to pay a higher tax rate as opposed to an individual. Let's say we're talking about a taxable income of $100,000. An individual would pay 28% on that, a tax rate of 28%. Corporation has a tax rate of, I think, 36% at $100,000. Now, over $414,000, the individual has a higher tax rate. The individual has 39.6% tax. Over $414,000, a corporation could be taxed at the rate of 36, 39, maybe 38%. And it depends on the actual income. But if you notice, none of those numbers are greater than 39.6%. They're all less than that. So over $414,000, a corporation is going to pay a lower tax rate. Okay. Another thing that differentiates individual tax treatment from corporate tax treatment lies in how capital gains are handled. A capital gain results when you sell capital property in excess of book value. Okay, so let's say you've got a piece of real estate that you bought in 1984 for $10,000 and you sell it today, 31 years later, for $1 million. Okay, you've got a capital gain on that of $900,000. I believe I said the original purchase price was $100,000. So you got a capital gain of $900,000 on that. And by the way, what is capital property? Capital property is essentially anything. Okay. To be more precise, it tends to be property that you've held for more than a year, that the business entity has held for more than a year, as opposed to ordinary income property, which is property you hold for less than a year. And ordinary income property tends to be your raw materials, operating supplies, things like that. Okay, so practically anything is capital gains property, or capital property, I should say. The furniture in your office, the light fixtures, the wall art, the carpeting, okay, the property, plant, and equipment, the intangible assets, the those all tend to be capital gains. I'm sorry, capital property. And if you sell it and you receive a gain, then that's capital gains. And if you have a recognized gain, you have to pay taxes. More on that in a second.